In September, the Federal Reserve finally cut rates by 25 basis points, the first cut of 2025. For many investors, this feels like a turning point, as if another rally is about to begin. Right after the announcement, reactions were mixed. Some stock indexes moved higher, but tech actually came under pressure. Treasury yields went up, not down. And in commodities, gold and oil barely moved, showing the cut was already priced in. But what really matters is Powell's own description of the economy at the press conference. While the unemployment rate remains low, it has edged up, job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. That's the contradiction. The economy isn't strong, inflation isn't solved, yet the easing cycle has already started. Look closer at the data, and the picture is less rosy. The labor market is slowing, unemployment is creeping up. Retail growth might look like 2.7 to 3.7%, but that's only nominal. If inflation runs near 3%, real purchasing power is flat at best, and possibly falling. This rate cut wasn't because the economy is booming. It happened because growth is weakening, and the Fed had to ease earlier than expected. Now here's the interesting part. Normally, rate cuts push bond yields down. This time, yields went up. That tells you the market doesn't fully believe inflation is under control. Investors fear the Fed is cutting too soon, which could reignite inflation. So on the surface, people are celebrating a rate cut rally. But underneath, the bond market is already flashing warning signs. Inflation was never truly solved. Yes, it's down from the peak, but it's still above target. And energy, food, tariffs, all can push prices back up quickly. Cutting rates now means more liquidity, and that could bring inflation right back. That's the Fed's biggest contradiction, trying to support growth while risking a return of inflation. For investors, this creates a real dilemma. Hold cash? Inflation eats it away. Chase assets? Prices are already inflated, and if policy flips again, you face big risks. Either way, it's not straightforward. That's why the smartest approach now isn't to bet on one direction, but to diversify aggressively. Yes, rate cuts fuel liquidity, but the real hidden risk is inflation. Ignore that, and you're exposed. So next, let's break down a few key asset classes, their current risks, and what they might mean for your portfolio. I'd put gold at the top. Inflation risk is still here, policy is uncertain, and gold, as a non-credit asset, is the most reliable hedge. Central banks have been buying at record levels. Combine that with de-dollarization, and gold has become the neutral reserve asset. It can't be sanctioned, and that's why it's the top choice for risk diversification. In the short term, rising yields remain a risk, since higher real yields usually weigh on gold. But in recent years, even with rates staying high, gold has kept making new highs. The reason is that central bank demand, geopolitical tensions, and inflation uncertainty have all become stronger drivers than interest rates alone. So short-term volatility? Sure, but long-term support remains strong. Gold isn't just a trading instrument, it's a core hedge against policy errors and systemic risks. Next, short to medium-term quality bonds. On the surface, rate cuts are the most direct support for bonds. As yields fall, prices get a lift. But if inflation stays around 3%, the returns you get from these bonds will struggle to beat inflation. Still, that's better than holding cash, which offers no protection at all, while bonds at least provide a relatively stable income. By contrast, long bonds carry much greater risk. If inflation comes back, long-duration bonds can suffer severe price swings and large losses. So at this stage, short to medium-term treasuries or investment-grade bonds aren't a cure for inflation, but they can serve as a low-risk parking spot for capital. Third comes equities. Cuts are usually good for stocks, but valuations today are stretched. The rally has been driven by liquidity, not earnings. The S&P 500's CAPE ratio is around 37 to 39. Its standard PE is about 27 to 30. Both are well above averages. That's measurable bubble risk. And the bubble source? Tech and AI names. A handful of megacaps lifted the index, while most other sectors didn't see earnings growth. The market looks strong on the outside, but the inside is fragile. Add slowing jobs, weak retail, and sluggish real estate, and the earnings base is thin. If growth weakens further, stocks could rally first, then reverse sharply. So yes, large indexes and solid companies are safer, but equities now look more like speculation than steady allocation. Here's how I'd filter. Large blue chips with stable cash flow and dividends, healthcare, consumer staples, they hold up in slowdowns. Rate-sensitive sectors, housing, infrastructure, certain financials, benefit as funding costs fall. Core tech leaders with real earnings and cash flow, still capital magnets. But avoid fringe story stocks. High dividend stocks or ETFs, in volatile markets, cash returns give stability. In short, stocks are still viable, but stick to real strength, avoid the bubbles, and don't over-concentrate. Finally, crypto and EM assets. Rate cuts boost liquidity, and capital flows into high-risk areas. Bitcoin is the prime example. Its advantage? Like gold, it's non-sovereign, outside any government's control. In times of capital controls or geopolitical tension, Bitcoin is an alternative escape valve. That's why more institutions, even some sovereigns, are calling it on-chain gold. But risks are bigger here. Extreme volatility, double-digit swings are normal. Regulation is uncertain. US, Europe, EMs may impose limits anytime. Holdings are concentrated. The top 2% of wallets hold most supply, making it easy to move prices. And every 4 years, block rewards halve. If prices don't rise, miners get squeezed, hash rates drop, and forced selling hits the market. So crypto? Yes, but only as a small, high-risk slice. Not the core, just a supplement. So in summary, yes, the Fed has started cutting, and markets look upbeat. But bond yields' unusual rise tells you inflation is far from dead. This cycle may not be a one-way bull run. It may be a tug of war between asset optimism and inflation risk. For investors, the key isn't chasing the hottest trade. It's building a portfolio that can truly survive uncertainty. So let me ask you, how would you position yourself? If this analysis gave you something to think about, don't forget to subscribe and share. Let's get more people thinking together.